All right. Hello, you trader nerds, and welcome into a fabulous Friday. It is a wonderful day to be alive, and we survived the hurricane last night. Power went off for a few hours, but it is back up, and the internet appears to be working, so we are ready to roll. Just got a little bit of rain, but not a lot of wind either. It was surprisingly light here in the lovely little town of Bowden, Georgia. It's probably blowing more right now than it was last night, but we survived it well. So hope everybody was safe that was in the path of the storm and still in the path of the storm as it's going through. Had a couple of people perish in Georgia, which was kind of sad from the storm and tornadoes and things, and that's always sad. But y'all stay safe and glad to see everybody out. I'm really excited, y'all. I spent a lot of time yesterday on um, Chat GPT and Claude. And Claude, y'all, if you've not used Claude.ai, it's fabulous. Just fabulous. And it basically, uh, I come up with a strategy and it does all this stuff over here. And now I'm using it to do the spreadsheet and to figure out the strategy and everything. And it was really good. And let's see, let me just tell Claude something. I have some friends here and I want to show them what we came up with. Can you first show them a buy and hold strategy of TQQQ beginning with $100,000 portfolio beginning at TQQQ's inception in 2010 through the present. Okay. So basically it's going to show you, show the CAGR and the stats. So we'll put that in there. And so what it does is it comes in and it demonstrates a buy and hold strategy. So if you and I had the forethought back in February of 2010, if we had put in $100,000 into TQQ, which is the triple leveraged ETF, was very, 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 very volatile. So everybody's got to remember that this is very, very, very volatile. Then what it came up with was a final portfolio value as of June the 30th of $15 million. So you would have had right at $16 million in what, 14, 15 years with a $100,000 investment. Now, the Sharpe ratio is the higher the better, it's 1.02. The max drawdown was 81.33, but you had a 47.65% annual return. Best year was 2020. You were up 271%. The worst year, of course, and we knew that this is the worst year of all. We tested it, was 2022 with a 62.51% loss. And it does have annualized volatility of 64.73%. So I don't want a single one of you going out there and putting 100% of your portfolio into TQQ thinking that it's the end all be all. It would have been if we had, now we would have had an 81% drawdown, and most of us probably would not be able to stomach going through an 81% drawdown. But at the same time, your $100,000 gave 16 billion. I think I could be okay. I think I would be just fine. So I have been working both with Chat GPT and with Claude, and we've done some work in both of them. And I've basically given some prompts to try to develop a strategy that would outperform the buy and hold TQQQ in the back test. Now, of course, back tests are back tests, and it's been a very stellar bull market and la, 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 la. We don't know if that'll ever continue and all that. But I basically gave the Claude back tester some information that we wanted to, see how this would work. Basically, we changed up the VIX levels. We changed up a lot of things. Yeah, that's Pascal. That is a 81%. It's very scary for sure, no doubt. But we came up with a couple of things that we think that we have optimized a strategy. I think that I have optimized a strategy that would probably do fairly well going forward in the future based on what it did in the past. So we're going to now ask Claude here, my friend Claude, basically to run the optimized strategy that I've developed. Now, I want to say that I've developed, I did give the prompts on different things that I wanted to have in it. And Claude suggested some things that we do to it, but I just wanted to show you kind of the power of the back testing and doing all the different things, right? So now I'm going to ask Claude, I'm going to say, please run the back test for our latest optimized strategy and compare to buy and hold. Okay, so let's just do this. So you would have had 15 million. So if we implemented the prompts and the different allocations that I've done, basically, and he or she or whatever Claude is a he or a she, basically is going to run what we've come up with here. And what is interesting is that the optimized strategy has a final portfolio value. Now, it's almost to a point that I'm like, could it possibly be true? Because the buy and hold, you were at 15 million, and the optimized strategy would be at 52 million with a total return of 52,000%. Max drawdown, still big, is 53.21%, but it had a 52% growth rate. Again, now, ladies and gentlemen, technology stocks could just basically do nothing. But am I willing to say maybe take $75,000 and just say, hey, let's piss it in the wind and let's just see what happens? Yeah, I probably am, just to see how this would do. So the final portfolio value outperformed by $36 million, it said. Total return, our strategy achieved 3.31 times the return of buy and hold. Let's see, max drawdown was reduced by 28.12 percentage points, and our strategy achieved a 0.56 higher Sharpe ratio, indicating better risk-adjusted returns. So, and I like what it says here. It's even telling me, hey, look, dummy, don't you think that you're ever going to get these kind of results, okay, based on the future? It's important to note that these results are based on back testing and hypothetical performance. Real world implementation may face additional challenges, taxes, transaction costs, strategy drift. And of course, we have probably violated every bias possible in looking at the back test, historical, we historical fitting it to do what we wanted it to do and all of that things, and past performance doesn't guarantee future results. But he does say that our optimized strategy demonstrates the potential for enhancing returns while managing risk and leverage ETF investing. The significant outperformance and improved risk metrics suggests that the added complexity of strategy may be worthwhile for investors comfortable with active management and willing to adhere to a systematic approach. Let's see if I think I gave him let's see if he can do this. Can you compare our optimized strategy to Kelly's 9-sig strategy? I think you'll remember that we ran the 9-sig back test previously. Now, if you don't know what the 9-sig is, it basically says, if you're have $100,000 account, in that first quarter, you would account for 9% growth. So you would say, is the account grown to 109,000? If it did not, you would buy an additional amount of TQQQ to get it up to the 9%. That's how much you would buy. And if you overperform and say you were up 12%, then you would sell off the 3% that you made compared to the 9%. So it's a very, very robust strategy as well. But we actually had Claude to run the back test on it. Let's just see if he remembers. I can pull that up. You're right. We did run a back test for Kelly's 9 sig, and here's kind of how it worked out. The Kelly 9 sig, now it did very well, ladies and gentlemen. The 9 sig did very good with a final portfolio value of 4,276,000. I don't think anybody would be complaining on that. It's had a 33% annual return. Max drawdown, though, is more significant than the strategy that we have developed here, and the Sharpe ratio is lower. And then it compares it against buy and hold. So really, buy and hold would have been the way to go. The 9 sig strategy came up with this. Now, I don't think that that Claude was familiar enough with. I had to teach it what the 9 sig strategy was. I don't think that it was able to take Lacello's aim and to do anything. So what we're going to do today is we're going to basically start this strategy on Tuesday. So we're going to do it Tuesday, and we're going to basically put a portion of our money into a very, very risky asset, and that is TQQQ. And if you are looking out there, you're going to see a lot of people talking about the volatility decay and that you can't hold it, and that's fine. At least I'm willing to gamble $75,000 on the strategy that we've developed. So a lot of people are saying, okay, Bobby, I want to know what the strategy is. And so we'll unleash that at time. But for today's purposes, we're going to unload that on our Muscadine Mafia folks. So the Muscadine Mafia folks are our esteemed members, and we meet every Friday, and I'm going to really dig into the depths of the new strategy. So I know what you guys on YouTube are going to say. Oh, Bobby, you back test, you overfitted the thing to make sure that it turned out $53 million, blah, 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 blah. I understand all of those comments, and you're exactly right. And it probably is not going to work in the future, and this is probably going to be a really, really horrible experiment. But am I willing to at least do $75,000 into the strategy? And yes, I am. I am willing to do that. So that's what I'm saying. So if I lose 75,000, I'll be willing to that. Now, what I like about this strategy, and Claude does not know that I have a put buying campaign, basically where I have he doesn't know about the Sweet Bobby hedge. Okay. So Claude doesn't know he knows that I do something in order to hedge, but he doesn't know about the Sweet Bobby hedge. So the Sweet Bobby hedge will still be a part of the program, in addition to the little program that we've done here with the optimized thing back to here. Now, here's what I also wanted to show you is the worst time, okay, that you could have possibly started this thing was in 2022. That's the worst year. Please run a back test of our strategy from January 1st, 2022 through present. Yeah, there you go. And so let's see how the worst case scenario was of our thing. So let's say that we are at market tops now, and I go into this strategy and it's just horrible. How bad might it be? So let's see what Claude says here. And it was kind of good because he can run it from 2022 to the present, which was, again, the worst time to be in this. So let's see what he says. He runs a back test. You'll notice he comes up with all the Python stuff here when he's running the back test. He's got VIX levels here. He's got TQQ returns. He's doing all this amazing stuff on the right. And so let's see what he comes up with. This period is particularly interesting as it includes the recent market volatility and downturn. So here's what happened. So if we had started this strategy January 22 through the present, the optimized strategy would have been a final portfolio value of this. Our total return would only have been down. Now remember, this is the worst time to possibly start this, and the max drawdown was 29%, but we're back at 98%. Now, here's what I want to do, because this is the way we're actually going to do it now. Now, I want you to implement the new capital rule that you and I developed, where in 2022, we broke the $100,000 into 6 monthly contributions to the plan, and contrast that with placing 100 fully into the plan from 2022 through the present. All right, so we'll let him do that. What are y'all saying here? Let's see. Will you be selling options to enter or cover calls on shares? Matt, that is exactly something that I've thought about. That's a good way to get into the strategy, isn't it? To do that. So yes, that could be a part of what we're doing. So basically, it's saying gradual investment 16,666.67 for the 6 months versus a lump sum investment of the $100,000. So basically, what we've done is Claude and I worked together to okay, so it had done the lump sum to start with. Yeah, that's what I thought it was. So the gradual investment to the present was the 98,000. That's what I thought. Total return negative 1.02, 29% drawdown. If you had immediately put in your $100,000 at the worst time for this strategy, 2022 was horrific. If you had put in the entire 2022 there, then you'd be down to 81,000 today. So you'd be losing what, 19,000 or so. And so your total return would be 18%. Your average yearly returns negative 8%, and your max drawdown was a whopping 52%. So the gradual investment strategy outperformed. And that's what we're going to be doing now, because I was basically telling Claude, hey, Claude, we're at market highs here. I kind of feel bad about putting $75,000 into a TQQQ program when we're at all market highs. So we basically came up with some strategies to do that. And the cool thing is, y'all, that the automated, the AI actually comes up with ideas, and it takes a lot of your ideas, but then it will elaborate on different things. And that's what it has done, and why we've come up with this strategy. And I think it's going to be a fun strategy to run. Now, keep in mind, you gotta have the cojones to stick through the drawdowns, okay? You gotta have the cojones to stick through the drawdowns. The drawdowns are kind of big, but one of the things that I thought about, I told Beth last night, I said there's a couple ways that we could run this. I said the algorithm that we've developed with artificial intelligence and my prompting, we've created something, and basically I could just give you guys the signal, right? And I could give you the signal every month that says, okay, put this amount of your portfolio into TQQQ and this amount of your portfolio into a cash equivalent or a bond fund like Bill. So that was one way that we did it. But then I said, I don't want to do that, because I want you guys to have the secret sauce. I want you guys to be able to run this. And what better way to get it out there than to give it to our Muscadine Mafia members first? Everybody will eventually get it, but I think the Muscadine Mafia members, they pay extra and they get cool stuff first. So I think at this time we're going to go into Muscadine Mafia, and we're going to go into the weeds on the strategy. And I think you all are going to be really, really impressed with what we find. Now, keep in mind, I don't want everybody, this is a long-term investing plan, not a short-term plan. It is long-term. Yes, it is long-term. So this is money that I have that is basically play money. Okay, I'm willing to play with 75,000, realizing that we could have significant drawdowns, but it's long term. And as Matt Jollywally has already said, it may be that I'll sell options to get in there, right? If it says, hey, I got to put $16,000 in on Tuesday when I start, or it'll be less than that, $10,000, $12,000, then maybe the best way to do that is to sell some puts in order to get into our first. And if you don't get in, then you've got the income from that. And then when you do have the shares, we could certainly juice those by selling calls against it. And remember, the black swan hedge is key. It's still there. It's running in the background. It is there to help us, to protect us in the event of a huge 20%, 15% drop in the market. So all of you, I love you to pieces. I thank you for joining me every day. This is going to be an exciting little thing, and it's basically something totally new for us. It's kind of a combination of AIM. It's kind of a combination of the 9 sig. It's kind of a combination of a lot of different things. And I think that this is money I'm planning to leave to my kids. That's exactly right. This is fun money. This is something that you're like, hey, we got 75,000 in this one account. Let's put it on red. Right. Let's roll the dice. So I don't know if many of you you may just want to follow along. I'm not sure that you want to do this, but I know what's happening. Some of y'all are sitting here going, holy hell, 52. If technology stocks continue to do good, the 52 million certainly is something to definitely look at. All right, y'all have a good rest of your day. Have a great weekend. I will see y'all Monday, and we're going immediately into Muscadine Mafia. I will see y'all there.